Now speaking, J.C. Weigelt, Vice President, Investor Relations. Good morning or afternoon, everyone. I am J.C. Weigelt, Vice President of Investor Relations at Polaris. Today, we are discussing our 2023 second quarter earnings call. Joining me on the call are Mike Speetzen, our Chief Executive Officer, and Bob Mack, our Chief Financial Officer. They will provide an overview of our second quarter results and expectations for 2023. All references to second quarter 2023 actual results and 2023 guidance are for our continuing operations and are reported on an adjusted non-GAAP basis. Our Reg G reconciliation schedules are available at the end of the presentation. Now, I will turn it over to Mike Speetzen. Now speaking, Mike Speetzen, Chief Executive Officer. Polaris had a successful second quarter, with sales growing 7% and share gains in off-road, on-road, and marine. Margins were down modestly due to higher interest, foreign exchange, and snow warranty costs, as well as production inefficiencies due to supplier delivery and labor market challenges. Adjusted EPS was flat relative to the prior year. Retail demand improved in off-road and on-road, while marine saw more challenges. Polaris is focused on its 5-year strategy and margin expansion to generate strong returns for shareholders. The company is raising its sales guidance, but increased costs incurred during the year thus far and anticipated in the second half have narrowed its adjusted EPS guidance. Polaris is winning the innovation race with the launch of the Pro, RZR Pro R, and Turbo R, and RZR XP, as well as the Polaris Expedition. Dealer sentiment has improved, and they are optimistic about how promotions and product availability can positively impact retail. July retail is off to a good start for the third quarter. Bob will provide more detail on guidance and expectations for the balance of 2023. Now speaking, Bob Mack, Chief Financial Officer. Good morning or afternoon to everyone on the call today. Polaris had an encouraging second quarter with top-line growth of 7%, share gains in off-road, on-road, and marine, double-digit retail growth, and the introduction of the Polaris Expedition. EBITDA margin for the quarter was down almost 40 basis points, driven by labor costs, finance interest, snow warranty expense, and litigation costs. International sales grew 6%, and PG&A grew 12%. Off-road revenue increased 9%, driven primarily by side-by-side sales, and ORV retail was up 14%. On-road posted fourth straight quarter of share gains, driven by strong product portfolio and healthy inventory. North American Indian motorcycle retail was up over 40%, and European brands Aixam and Goupil had double-digit growth in sales and gross profit. On-road gross profit margin was up 480 basis points. Marine results were lower than expected due to softer start to the selling season, but Bennington gained some modest share. Gross profit margin was up 130 basis points. Cash generation in the first half was strong, and net leverage ratio is healthy at 1.5 times. We repurchased almost 1 million shares during the first half of the year. Guidance for the year has been adjusted to sales up 3% to 6%, off-road up high single digits, on-road up low single digits, and marine down mid-teens. Gross profit margin guidance is 10 to 40 basis points expansion, and EBITDA margin guidance is up 20 to 40 basis points. We expect retail to be flattish in the third quarter due to pressure and seasonality from on-road and marine, and margins are expected to be down modestly year over year. We remain on track to meet our guidance halfway through the year and have raised our outlook for sales while narrowing other metrics. Now speaking, Mike Speetzen, Chief Executive Officer. We are pleased to report that the first half of the year has been successful and sets us up for a successful second half. Industry retail is estimated to be flattish this year, however, the results in the second quarter point to a stronger environment than expected. We have been bullish on innovation with the launch of RZR XP and Polaris Expedition, and we look forward to sharing more with our dealers and customers. Operationally, the business is running smoother than the past couple of years, however, there are still opportunities to address efficiencies within the supply chain and manufacturing facilities. We are focused on expanding margins and meeting all of our 5-year targets. Next week's Capital Market Day will be a great opportunity to update you on the progress to these targets and what still needs to be done to deliver strong returns for shareholders. We thank you for your continued support and look forward to seeing many of you in person in Nashville next week. Robert W. Baird & Company analyst Craig Kennison inquired, can you provide more clarity on your Q3 retail guidance, specifically what is driving the expected year-over-year growth? Mike Speetzen replied, Craig, thanks for the question. Year-over-year comps have been affected by product availability in both 22 and 21. Q2 to Q3 retail dropped sequentially, so we're expecting a relatively flat performance compared to 2019. This is mainly due to our off-road vehicles, which are seeing continued strength in the utility market and slightly better than expected recreation sales. We also have 2 new products and another one coming soon, which should help us in the third and fourth quarters from a retail perspective. Citi analyst James Hardiman inquired, could you please quantify the impact of production inefficiencies in labor, warranty, and litigation costs on margins and OPEX? Bob Mack replied, James, cost-wise, we're seeing progress on ocean freight and labor, but still have parts shortages with suppliers. We anticipate headwinds of over $40 million in the second half of the year due to inefficiencies in plants, excess labor and warehousing. On the OPEX side, legal costs are higher than expected due to cases coming through the court system as they reopen from COVID. We feel confident in our product liability stability going forward. Mike Speetsen replied, James, the quarter looks good overall, but we're still dealing with the wire harness issue. Our rework is down from the last couple of years, but it's still up significantly from pre-pandemic levels. We've been working with our supplier to improve the situation and have seen sequential improvement. We need to get caught up, so we're investing in labor to get vehicles out to meet customer demand. We anticipate the headwinds will dissipate, but it will still be higher than originally expected for the year. Citi analyst James Hardiman inquired, can Expedition and the other game-changing ORV product fill the gap of replenishment from a year ago, or will it create a headwind for the second half? Mike Speetsen replied, James, in the second half of 2023, we anticipate channel refill of $600 million, with 75% of that coming from new products such as Expedition, RZR, and snowmobiles. We expect to ship $100 million worth of snowmobiles in Q3, which is a more normal cadence than in 2022 when we struggled to get snowmobiles out in time for snow season. KeyBank Capital Markets analyst Noah Zatzkin inquired, could you please discuss the levers you pulled to expand gross margins in the marine channel and how you're thinking about margins for the rest of the year? Mike Speetsen replied, this year, we saw good, though not expected, shipments in the first half of the year. We had a favorable mix of higher-end boats, which helped us expand margins. We've also implemented automation and lean processes in our factories to drive better margins. In the second half of the year, revenue is expected to be down and margins will be challenged due to variable costs. We've adjusted production schedules to account for retail and dealer inventory. We saw some share gains on the Bennington side, our biggest brand, but it's tough to predict what the back half of the year will look like. We're preparing for it to be soft and we'll have a better sense after our dealer meetings in early August. We're taking necessary actions to protect margins in the second half. Wolfe Research analyst Fred Whiteman inquired, can you discuss the performance of the RFM program in light of dealer inventories, competitive dynamics, and seasonality? Bob Mack replied, Fred, overall, feedback from dealers was positive. We're doing a better job than most getting product into the channel. From an RFM standpoint, we're getting good signals. We're still struggling on the high end of the business due to supplier disruption in higher part content in vehicles. This has a larger impact on the Ranger business as the super premium segment has become a larger portion. Inventory is down from 2019, but ASPs are up, making it difficult for dealers to floor. Low-end OEMs have induced truckload buys that dealers are trying to digest, but consumer demand is low. We're focused on getting high-end products to dealers and have seen a significant improvement in our ability to get Ranger North Star, which will continue to improve in the back half of the year. Wolfe Research analyst Fred Whiteman inquired, what caused the shift in the expected 40-60, first half back half cadence to a 50-50 split? Bob Mack replied, I wouldn't say there was a pull forward in terms of revenues and shipments. We had favorable mix in the first half, with higher-end vehicles being shipped out. Net price promo was also decent, resulting in better financial results than expected. Raymond James analyst Joe Altabello inquired, what drove the improvement in rec ORV demand and share gains in India during the quarter? Mike Speetsen replied, on the rec side, we saw strength in the crossover category. The high end of the RZR category is performing well and our delivery has improved due to the recalls from last year and early this year. The low to mid-range of the market has not seen significant change, but the crossover category remains strong. This is likely due to the utility of these vehicles for multi-acre homeowners. The high end of our categories have been holding up well due to favorable employment and income levels. Bob Mack replied, we saw strong growth in the Indian market, particularly in the midsize segment. This was due to the resolution of issues with black-painted parts last year, which had previously inhibited dealer inventory. As midsize motorcycles are often impulse purchases for new buyers, having inventory available during the prime selling season in the first half of the year was key to our success. Raymond James analyst Joe Altabello inquired, how do you see the margin progression over the next several years? Is it back-end weighted or will there be improvement in 24? Bob Mack replied, we are continuing to drive both short-term and long-term activities to improve margins. We have some headwinds due to FX, but we are working to overcome that and our targets remain unchanged. We are addressing near-term operational inefficiencies and price-cost ratios, which were aided by the success of Indian and Slingshot. At our Capital Markets Day, we will discuss longer-term strategies around factories and product design. Mike Speedsen replied, foreign exchange had a significant impact on us in the first half of the year, reducing our gross profit by nearly 1 point. We are working to overcome this and other cost issues, and we are confident that our factories will become more efficient and our suppliers will deliver at a stronger rate. We look forward to providing more information next week. UBS analyst Arpine Kacharian inquired, could you provide an update on ORV retail performance in July and the full-year outlook? Mike Speedsen replied, our off-road vehicle, ORV, segment has seen continued strength in July, with sales up compared to both last year and 2019. The marine segment is still soft, while on-road is slowing down seasonally. We expect ORV to remain up, gaining market share with the addition of several new products, such as the RZR XP and Polaris Expedition, as well as an upcoming yet-to-be-announced product. This will drive incremental retail and contribute to the strength of our off-road segment. UBS analyst Arpine Kacharian inquired, what strategies do you have in place to ensure the profitability of lower-end OEMs versus Polaris? Mike Speedsen replied, I believe our competitors were able to achieve profitability due to their ability to ship lower-end products when we and other mid to high-end companies were not. I've heard from dealers that the margin dynamic is changing significantly, with them having to pay a lot of interest on units and do a lot of discounting. We remain confident in our position and are still looking at ways to improve our value and entry-level offerings. We are confident in our product lineup and competitive edge moving forward. UBS analyst Arpine Kacharian inquired, could you quantify the impact of production inefficiency in off-road on margin? Bob Mack replied, we anticipate $40 million in revenue for the second half of the year. BMO Capital Markets analyst Tristan Thomas inquired, can you confirm the full-year impact of the $40 million and 1 point of margin is $75 million? Bob Mack replied, the impact of FX on our first half performance was 1 point. BMO Capital Markets analyst Tristan Thomas inquired, what is the margin impact of the $40 million in the first half, and is it expected to remain the same in the second half? Mike Speedsen replied, the rework levels we've seen have had an impact on our expected performance in the second half of the year. We anticipated that our efficiency would improve, but it hasn't materialized as quickly as we had hoped. We are making progress with one supplier, and we expect to see improvements sequentially, but it won't be at the same rate we initially anticipated. Bob Mack replied, we have seen a significant improvement in our performance compared to 2022. However, we are not seeing the same level of improvement in the second half of the year as we had anticipated when we provided guidance. BMO Capital Markets analyst Tristan Thomas inquired, can you provide an overview of marine retail trends at different price points? Bob Mack replied, I would say that the higher-end products have been strong in the first half of the year. However, we've seen a shift in the last couple of months with smaller boats performing better from a retail perspective. This could be due to higher finance rates for longer boat loans and higher cost of boats, which may be driving consumers towards cheaper, smaller boats. Longbow research analyst Dave McGregor inquired, Mike, what is causing the softer sales patterns in the low and medium segment of the ORV line? Is it consumer interest or credit constraints? Mike Speedsen replied, the lead generation for our company is strong, both organically and through inorganic means. The hesitation we're seeing is likely due to two factors, the talk of a recession and higher interest rates. We are actively working to reduce the impact of higher rates by investing in promotional activities that help buyers finance at lower rates. We will be discussing this further at our dealer meeting next week. Hopefully, with good news on the economic front, the pressure will start to abate and, if the Fed provides stability, it could work in our favor. We are committed to helping consumers out with promotional activities. Longbow research analyst Dave McGregor inquired, how are consumers responding differently to promotions on road versus off-road? Bob Mack replied, there is not a significant difference between finance promo and rebate offers. Mike mentioned that finance promo is beginning to be favored more than rebate offers. We have not seen any changes in consumer behavior between the two. The only difference between on-road and off-road is that trade-ins are more common in on-road, but these cases are rare and not a major factor. Mike Speedsen replied, I'd say our approach to spending has evolved. We're doing more targeted offers and tests to see if discounts or buy-down of rates works. We've invested in CRM capabilities to better pinpoint and target customers. As a result, we're using money more efficiently and promos are down relative to where they were historically. This is especially beneficial given the current high interest rates. Morgan Stanley analyst Jamie Katz inquired, what is the current consumer interest in the EV business and how do you see it evolving over time? Mike Speedsen replied, the receptivity for the XP Kinetic has been incredibly strong. Customer feedback has been very positive and there are a number of independent reviews that have given us some of the best ratings we've ever received. We anticipate that when we open up a second ordering window, likely in the near future, demand will remain high. We plan to continue focusing on the utility segment, as it has proven to be an area of success for us. We will continue to evolve our Ranger vehicle and other product lines accordingly. Morgan Stanley analyst Jamie Katz inquired, what strategies are you considering to increase market share in the snowmobile industry following Yamaha's exit? Mike Speetsen replied, yeah, I think the news about Yamaha is certainly going to provide a lift. However, we're still discussing the implications with our board given the recent recency of the news. They are a small player in the market and there are broader implications for one of their competitors. We'll continue to monitor the situation. We had a great dealer meeting recently where we discussed changes to our business, such as renewed focus on quality and simplification. Our team has done an excellent job of ensuring that we can deliver our sleds ahead of the season. We even put a big incentive on the back of that to show how serious we are. I'm really excited about what we have to offer and I'm confident that we'll be in a great spot regardless of what Yamaha does. Exane BNP Paribas analyst Shen Xiu inquired, can you provide an update on the inventory levels relative to 2019 and what we can expect in terms of destocking in Q3? Mike Speetsen replied, overall, we're monitoring dealer inventory closely. We're seeing some areas where it's a bit heavier than we'd like, but we're also seeing areas where it's lower than we'd like. We're actively rebalancing the inventory to ensure that dealers have the right mix of vehicles to meet customer demand. We're also preparing for the influx of new vehicles coming to market in Q3 and Q4, making sure that dealers are stocked with these category-defining vehicles. Exane BNP Paribas analyst Shen Xiu inquired, did I hear correctly that you expect 3Q retail to be flat versus 2019, despite 2Q being down 5%? Bob Mack replied, we anticipate that 2022 will be a relatively flat year compared to 2019, with the industry as a whole performing slightly better than that. We are confident that we will be able to take market share and outperform the industry. In 2020, the industry was 10% below 2019 levels, and if that trend continues into the second half of the year, we expect to be relatively flat to 2019 and take some share. D.A. Davidson analyst Brandon Rawl inquired, what do you expect for market share in 3Q and 4Q? Mike Speetsen replied, I believe that channel fill in Q2 made a significant difference. We anticipate a return to more normal seasonality as we move into the second half of the year. We are targeting to continue gaining market share, however, last year's first half was particularly challenging due to a black paint issue. We do not expect similar dynamics to occur in the back half. D.A. Davidson analyst Brandon Rawl inquired, do you see the motorcycle industry in secular decline based on the underlying demand you're seeing in the market? Mike Speetsen replied, no, that's not the case. We have seen a large player in the market, but we remain optimistic about the potential of our platforms in the future of our business. Roth MKM analyst Scott Stember inquired, Mike, could you please discuss PG&A by segment and price point to give us an idea of how elastic the market is? Mike Speetsen replied, the PG&A performance has been strong, with increased content on our off-road vehicles due to factory install options. Repair activity and parts sales remain steady, and we don't see any cause for concern at this time. Average miles driven off-road are down slightly year over year, likely due to people returning to the office. Roth MKM analyst Scott Stember inquired, is it correct that the abatement of ORV production inefficiencies is $40 million lower than expected for the full year? Bob Mack replied, roughly speaking, we are seeing cost premiums and excess costs decline year over year, but not at the rate we had initially anticipated. We had expected a more gradual decrease throughout the year, so the impact is more pronounced in the second half.